Over the last 2 weeks, four of the biggest companies on earth told us the same thing. AI demand is insatiable. Compute is sold out. Not for this quarter, sold out through 2027 and bleeding into 2028 as well. And yet, around the same time, we also heard from Walmart and Uber, who quietly told us the exact opposite. They capped how much AI their employees are allowed to use. Uber burned through an entire year's worth of AI budget in just 4 months. Walmart pulled the plug on unlimited access to its own internal AI assistant because employees were spamming it with repetitive, low-value queries. So which is it? Is demand for AI so enormous that $100 billion build-outs are justified? Or are we all staring at the same illusion simply from different angles? And the real first customer just noticed the price tag. That's what we're digging into today. 4 earnings reports, 1 research note that should worry you, and 2 real Fortune 500 companies that just showed us what happens when the free lunch ends. If this story sounds interesting to you, please smash that like button and consider subscribing. It means the world. I produce content like this weekly. Let's get on with the real story. Starting with the case for optimism, because on the surface at least, it's a really great story. Amazon posted its first ever $200 billion revenue quarter. AWS, which many thought was losing the cloud race, reaccelerated to 37% year-over-year growth, crossing over $40 billion in revenue for the quarter, its fastest growth rate in over 4 years. Microsoft's cloud business, Azure, jumped 43% and crossed $100 billion in annual revenue for the first time in company's history. Google Cloud did all of that, but better, jumping 82%, nearly $25 billion in revenue for the quarter, on the back of enterprise demand for AI infrastructure. And even Meta, which we'll come back to again and again later throughout this video, still saw revenue growth of 28% to nearly $61 billion for the quarter, with its AI-powered ad targeting system crossing a staggering $75 billion in annual run rate. Combined, these 4 companies are spending a capital at a pace exceeding $700 billion for this year alone and projected to hit over $1 trillion next year. This is, by a wide margin, the largest infrastructure build-out in economic history. On paper at least, this looks like a boom with no ceiling in sight. And if you only read the headlines, you'd walk away thinking every single one of these companies and everything that they're doing is turning into gold. But you'd be wrong. Here's where the story splits. Meta's free cash flow didn't dip. It collapsed, down 91% year over year, from over $8 billion a year ago to less than $1 billion in their latest quarter. Alphabet posted its first negative quarterly free cash flow in almost 2 decades. Amazon's trailing 12-month free cash flow went negative too, swinging from a positive $18 billion just a year ago to now a deficit, as capital spending outruns cash coming in the door. Only one company avoided this entirely, Microsoft. It grew free cash flow to nearly $20 billion while still scaling Azure by nearly 43%. It's the only one of the 4 proving in real numbers that its AI spend is building on top of its core business instead of simply draining it. And the market noticed instantly. Microsoft's stock jumped roughly 8% after earnings. Meta and Alphabet both sold off, despite both companies beating revenue expectations. Investors didn't punish growth, they simply punished the absence of cash discipline. This matters because it's telling you something bigger. Wall Street has quietly changed the test. A year ago, spending billions on AI was enough to send most stocks soaring higher. Now, investors want to see that spending convert into actual cash flow, not just into a growth story on a slide. Now, just focusing on the latest quarter, if I had to rank these players on AI vision, execution, and commercial opportunity, I'd place Microsoft on top in S tier, followed closely by both Google and Amazon in A tier. In B tier, we find Meta swinging violently, trying to hit something, but that, ironically, could be a huge positive for the stock, as we'll see later in the video. So Microsoft provided absolute proof that there's money to be made here. And Amazon and Google, to a degree, said the same thing, despite their negative free cash flows. So that means the bull case must be safe then, right? Not so fast, because underneath all of this, there's a much more difficult question to answer. How much of this cloud revenue is even coming from broad-based businesses versus instead a small number of customers who don't actually have a profitable business of their own? UBS recently put out a research note that should make everyone sit up. In their estimates, OpenAI and Anthropic combined roughly account for 27% of Google's cloud revenue for this year. And by 2027, they project that number could go as high as 48%. Nearly half of Google's cloud businesses come from two unprofitable customers. And Google's not alone in getting money from Anthropic and OpenAI, Microsoft and AWS, obviously not to the same degree. But let's sit with what was just said for a second. We have two AI labs, none of them profitable, none of them open to public scrutiny, both of which are on pace to become the single largest driver of cloud growth for one of the biggest tech companies on the planet, as well as some of the other players. That means when you hear cloud revenue is accelerating, a meaningful and growing chunk of that isn't coming from regular businesses adopting AI. Instead, it's coming from a small number of frontier labs burning through cash, most of it investor cash, to pay for rent and pay for compute. Compute that then shows up on a hyperscaler's income statement as cash flow, as growth. Now, that doesn't mean that's fake money. Those are real dollar bills, believe it or not. It's not fake revenue. The dollars are real, but it's concentrated and fragile in a way that a simple headline of cloud revenue up 82% simply masks over. There's more detail, more nuance to the story. Here's the part of the story that I actually think matters the most because it moves us away from Wall Street math to the real world. Walmart and Uber are not AI labs. They're not frontier model developers. They are not hyperscalers. They are instead run-of-the-mill, massive corporations that are supposed to be the end customer for all of this build-out. And both of them just hit the brakes. Walmart had previously given its employees unlimited access to its internal AI assistant called CodePuppy. They just moved to a fixed token allocation instead because people there were firing off repetitive, duplicative queries once the tool was free. Uber took it a step further. It capped spending on AI coding tools, including our favorite, Claude Code, at around $1,500 per employee per month, after burning through an entire AI annual budget in just 4 months. Think about what this means. The exact monetization story that's supposed to justify all this infrastructure AI spend, the enterprise seats, the coding productivity assistants, the Microsoft 365 Copilot, the GitHub Copilot growth, all of those items were being celebrated and being used as a story to fuel all of this development. All of that is already running into real budget resistance at real companies. Now, this is not happening in some hypothetical future quarter. This is happening today, right now. This is what token shock looks like. Companies are finally discovering that AI usage at scale costs a lot more than when it was just free and used as an experiment. If you want proof that this skepticism isn't just internet commentary coming from me, look at the credit market, because bond investors don't trade on vibes. They trade on default risk. CoreWeave is one of the purest plays in this whole cycle, a company that exists purely to rent out raw AI compute to massive customers like OpenAI and Anthropic and the Department of Defense. Its 5-year credit default swap spreads have surged to levels implying a roughly 50% of default over the next 5 years. That's not some stock analyst being curious. That's not some crazy random guy recording YouTube videos claiming this stuff. That's the bond market, the part of finance that's usually right first, pricing in a coin flip chance that a heavily leveraged AI infrastructure company doesn't make it through this cycle intact. And what's worse, CoreWeave is not alone. On July 9th, Oracle had its credit rating knocked down to -BBB, the last stop before junk status. After that, you'll find the bond listed under JNK, the junk bond ETF. Anyways, combined with what we just talked about, combine that with the UBS concentration data and what Walmart and Uber are actively doing in terms of pulling back on AI spend, and you have 3 completely independent sources, the credit market, equity research, and actual corporate budgets, all pointing to the same underlying doubt from 3 different angles. Before going on, one detail I really want to circle on. CoreWeave is scheduled to report earnings August 11th, and the number that actually matters won't be the headline revenue. That's important without a doubt. But even more important than that is the relative mix between their concentrated backlog and the more flexible spot style bookings. If long-term contracts keep growing, but that flexible pay-as-you-go revenue starts shrinking, that's the market telling us something in real time. That's telling us that real-time enterprise AI usage is softening, even while multi-year lab deals hold up. Because large-scale frontier model development is fixed long-term contracts, while enterprise usage is that more pay-as-you-go type model. So that contract mix tells us a lot of what we need to know regarding enterprise demand for AI and whether it's real. I'll be tracking all of this so you don't have to, but obviously that means you should subscribe to this channel to stay informed, or at least consider subscribing. So where does this leave us? Realistically, there are two outcomes and unfortunately no middle ground. Outcome one, AI adoption keeps growing. Real enterprise demand shows up and replaces the current lab-driven concentration. And the companies that built the infrastructure first and control the most of their own stack end up owning the next decade of computing. In that world, this entire build-out looks brilliant in hindsight. Outcome two, demand disappoints, even by a little bit. The concentration UBS flag turns out to be the whole story instead of a temporary phase. The Walmart and Uber pullback becomes the norm instead of the exception. And years from now, people will ask how none of us saw it coming when the receipts were sitting right in front of us in an earnings call and in this YouTube video. Anyways, nobody knows which of these two futures is going to take place. Not me, not the analyst, not the CEO on some of these calls. Anyone who tells you with total and complete confidence that they know which way this is going to fall is lying to you and probably trying to sell you something. But what I do know is this. Right now, today, the second order trade is working. Hyperscalers, chip makers, memory producers, energy companies, money is genuinely flowing through the entire value chain, and it's showing up as real revenue and real cash flow for a lot of these businesses. Microsoft chief among them. That part isn't a story about the future. That's happening today, whether or not the AI thesis ultimately plays out. So the next logical question is, how do you structure a portfolio around everything we discussed? How do you position yourself to benefit if AI keeps mooning while at the same time protecting yourself against the downside if AI turns out to be overhyped? Now, there's a variety of factors to consider. Obviously, there's your risk tolerance, your time horizon, and how much time and energy you want to put into this. But before I go any further, I want to remind folks, I'm not a financial advisor. I'm not pretending to be one. I'm simply a person on YouTube sharing my thoughts and ideas on this space. You can use that information to construct a portfolio that reflects what you think is going to happen. But at the end of the day, you and you alone are responsible for what happens to your portfolio. Anyways, that said, I'll start with the easiest way to get involved down to the most involved way to get involved. And you can pick and choose where you want to sit on the spectrum. Obviously, the easiest way to get involved is through an ETF like QQQ. There you can get a more concentrated bet on technology and AI simply by holding that index and dollar cost average over time. Yes, there'll be some volatility. Yes, there'll be some drawdown. And ideally during those drawdowns, you'll actually deploy more capital. But at the end of the day, as long as you buy and hold and reinvest those dividends, they're not much, but you reinvest them, you'll be made whole over time. History has shown this. Now, you can take it one step further and get a little bit more deliberate exposure to the AI namespace. You can do that through the iShares ETF ARTY. It holds a collection of AI-specific names, and they have an expense ratio of around 0.47%, which is, it's not high, it's also not low. But anyways, that ETF will give you a more concentrated bet within the AI space. And if AI keeps booming, this ETF is going to keep taking off. And if it goes down, you'll still be holding names like Microsoft and Nvidia that have the resilience to go through and weather any storm. Now, to take it one step further, right? So that's a buy and hold ETF that's done for you. You can make your own ETF. You can't really make your own ETF, that's a lot of money, but you can replicate that using something like M1 Finance, and you can create a pie. And actually what I like to do is I like to look at different ETF providers such as like VNQ, and I pick the names that I like and put them into my custom pie, and that basically becomes my ETF. You can do the same thing looking at ARTY. Pick the names that you like. Maybe you want Microsoft, maybe you want Nvidia, maybe you want Micron. Put those names into your custom M1 Finance pie, and then rebalance that simply over time. Buy and hold, continue buying names when they draw down, and deploy capital strategically. And eventually you'll be made whole over time too. Again, you'll see more drawdowns, definitely more than QQQ, but over time you should be made whole. The next step is picking individual names and following those religiously. You want to buy, for example, Microsoft because they're the best in class today. That to me makes a lot of sense. If AI keeps booming, I think Microsoft is going to win big time. I would pair that, however, with a name that many might not think of. I would actually pair it with Meta, not because Meta has this strategic vision, but because it is swinging blindly, spending money like a drunken sailor, and yet still making money. If AI turns out to be overhyped and all that CapEx is overdone, well, Microsoft is going to be hurting, right? They're going to see their revenues get cut in half because they're going to lose money from OpenAI, they're going to lose money from Anthropic, they're going to lose money from Perplexity. But Meta doesn't have that problem, for better or for worse, right? They are still printing money despite not having a coherent AI strategy. Which means if AI turns out to be overplayed, ironically, Meta would be the best position to survive the fallout because they're not making money from it anyways, right? Well, I take that back. They're making some money in terms of the ad revenue. They're able to place better ads because they're AI models, but they're not making money by trying to sell this stuff to other people. So if AI falters, it's no harm done to them. They'll just continue selling ads. The third name to get some exposure to AI without taking on too much risk is everyone's favorite, Apple. They are not building data centers. They are not building their own AI frontier models. They're simply staying back and watching from the sidelines. Granted, their stock is not ripping and roaring like all the other names, but at the end of the day, they're still going to win. They are the distribution layer. When you're going to talk to your AI model on your phone, chances are it's going to be an iPhone, right? So they're going to pick the best in class AI model, throw it on the iPhone, slap an Apple logo on it, and call it a day. Sit back and collect that money. They're not going to be stressed. Now, that doesn't mean there's no risk with Apple. There's risk with any name, but at least you're not going to have the same level of risk on AI as you would with a Micron or NVIDIA, right? Anyways, that's it for this episode. If you found this interesting, educational, mildly informative, please smash that like button and consider subscribing. It means the world. Anyways, until next time, protect that lunch money.